This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
This video works through question 1 from the June 2010 Audit and Assurance International Stream examination. Before starting the video, you are strongly advised to download the appropriate paper from the ACCA website. So here's the question. This is about average length. It will be full of detail, and you are very strongly advised to attempt question 1 first and to use your 15-minute reading time to thoroughly get to know and understand the facts in the question. However, before you read the question, what you should always do is to go to the requirements, because they will alert you as to what the question is about. Then when you go and want to read the question, you will read it with much more insight about the sort of things you should be looking out for. So here are the requirements in some detail. And the first one is relating to audit risks. Remember, be on the lookout for the two-part requirements, identify and explain. We'll come back to this later. And the audit risks at the planning stage of the audit. In other words, before we start the audit, we are going to be alerted to some elements about the company which may give us some cause for concern. And then what we have to do is essentially to explain why we're doing this process. Why, before we get ourselves into the detail of auditing, we are making ourselves aware of the risks. And of course, these are necessary because it's probably going to affect the auditing we carry out. Part C wants us to look for suitable controls over the continuous or perpetual inventory, and in particular to ensure completeness and accuracy of the existing inventory records at the company. In other words, how they're doing at the moment. And it is focusing on only two assertions, completeness and accuracy. Part D asks you to describe 3 substantive procedures that should be performed at year-end to confirm the valuation of inventory and the completeness of provisions or contingent liabilities. Note that the very last one on contingent liabilities not really relating to inventory necessarily. The marking scheme there is pretty transparent. 3 marks for each of parts 1 and 2. Now what you should do is go and read carefully through the question with a concentration on part A. In other words, identifying and then trying to explain audit risks. So pause the recording now and go and read the downloaded copy of the exam and look for anything which to your mind gives rise to an audit risk, and be sure you can explain why you think it is a risk. Okay, now we're going to look at part A, identify and explain the audit risks identified at the planning stage of the audit of Smoothbrush Paints Company. The approach you should take here is to be really suspicious about any detail the examiner supplies to you. All questions go through a very rigorous editing process, and the safe assumption is that nothing gets in there by accident. So just starting to read it, you are the audit senior and you are commencing the planning of the audit for the year ended 31st of August. Smoothbrush Paints Company is a paint manufacturer, has been trading for 50 years. Now, it potentially was significant to take note of what they did. If this had been a very high-tech company or a company with very complicated processes going on, that would increase the inherent risk in the audit. In other words, the chance that errors were made initially. And similarly, if it had been a relatively new company with inexperienced staff and so on, the chance of errors occurring in the financial statement is greater. But paint manufacturing is fairly old technology, fairly simple technology. The company's been around for 50 years, and presumably there's a good chance that it's going to be doing things correctly. So that's quite good news, both those quite good news. Similarly, it says it operates from one central site, and again that's good news. It is much more difficult performing an audit if, say, there were 6 different branches around the place, making sure that any intercompany balances, interdivisional balances were reconciled, making sure the inventory was correctly accounted for, and so on, is much more difficult. But one site, one centralized site, makes it easy. We had to consider all of these just to see if there's a risk there, and then to kind of dismiss it. Smoothbrush sells all its goods to large home improvement stores, with 60% going to one large chain, Homewares. Now that is a risk factor. If you have 60% of your output going to one particular customer, what happens if that customer were to go into liquidation? What happens if next year that customer doesn't award you the order again? And it says here it is a 1-year contract. And I think this raises potential going concern risks. If they were to lose this contract next year, would that mean that the company couldn't really survive, and maybe therefore we need to think about going concern? It's given here also information they have substantially reduced prices and they're offering 4-month credit periods. So in terms of reducing prices, I think there we'll be thinking of maybe a risk and inventory valuation. Inventory should be valued at the lower of cost net realizable value, and it could be that some of these prices are so low they're below cost. And also offering a 4-month credit period is quite dangerous. In a way, it gives the customer a 4-month opportunity to go into liquidation, and you lose your money. In recent years, Smoothbrush has reduced the levels of goods directly manufactured, and that in a way is probably reducing the risk maybe a little bit. If they're making less themselves, there'll be less work in progress, less difficulty maybe in valuing some of the inventory, and instead has started to import paint from South Asia. Approximately 60% is imported and 40% still manufactured. Further on, it says, purchase orders for overseas paint are made 6 months in advance, and then the goods can be in transit for up to 2 months. Smoothbrush accounts for inventory only when it receives goods. Now, there's a lot of information given there about the way this bought-in inventory is actually acquired, and you can't help but think that we should be making something out of that. It's good that they only account for inventory when it arrives. Otherwise, it would have been a real problem, maybe finding out how much was on the ship and so on. But if it's in transit for 2 months, there's a very good chance we've got the invoice in advance. We might have processed the invoice in advance, yet we haven't got the inventory and closing stocks. So there's a potential cut-off risk problem there, that we get the cut-off incorrect. And then it tells us, just going back a little bit, within the production facilities, a large amount of old paint and equipment that is now redundant with minimal scrap value. Very much a risk, 2 risk factors here, because it's old plant, not old paint, that we have to think to what extent that should be written down. There may be accelerated depreciation to comply with the proper valuation of non-current assets. To avoid disruption of a year-end inventory count, Smoothbrush has this year introduced, and always when something new is introduced, there's a risk that it goes wrong initially. People are learning how to deal with it. It's the first time we would have audited such a system in this company. And this continuous or perpetual inventory counting system may not operate very well. The warehouse has been divided into 12 areas, and these are each counted once over the year. Now, I would have thought that in 12 areas, are they counting 1 per month? If they're counting 1 per month, then by the time that the balance sheet date comes round, it could be 10, 11 months since we actually verified that inventory, and that could be quite a long time to be relying on a book figure. The accounting team includes one member of the internal audit department and a warehouse staff member. That's probably quite good. A nice kind of segregation of duties there. The internal audit person will watch the warehouse staff member. The warehouse staff member will be the expert as to what's actually being counted. And then the following procedures have been adopted. Let's see what they are. There we are. The team prints inventory quantities and descriptions from the system, and these records are compared to the inventory physically present. Now, I think that's probably wrong. In a way, you're telling these counters the answer. You're saying, this is what we think there should be, 90 litres or whatever it is, and there's a real risk they go out and maybe instead of counting it or just to cover up some sort of discrepancy, they put down, we'd found 90 litres. Much better if the inventory is counted without that information, then you compare it back to the inventory sheet, the book inventory. Any discrepancies are noted on inventory sheets, including any items not listed in the sheets but present in the warehouse area. Well, that's fine. That's looking at both missing and additional items there. Any damaged or old items are noted and they are removed from the inventory sheets. Should they be completely removed? Maybe there should be a write down. I think we could build up here a kind of a risk on inventory valuation. We know that a lot of this inventory has been sold at discounted prices. We have a new kind of cycle counting, perpetual stock taking going on there. We were not entirely happy with the procedures. They remove all old items, even if there might have been a small residual value. The sheets are then passed to the finance department for adjustments. That seems okay. During the counts, there will be continue to be inventory movements, and that makes actually counting the inventory very, very difficult. Ideally, you want to do inventory counts when everything is stopped, so you know exactly what you're dealing with. At the year end, it is proposed that the inventory will be based on the underlying records. Traditionally, a smooth brush has maintained an inventory provision based on 1% of the inventory value, but management feels that as inventory is being reviewed more regularly, it no longer needs this provision. But this is completely counter to the idea that we are selling this inventory at low cost, that it could be a long time since we have counted some of the inventory, that we are now becoming very reliant on how well this perpetual stock taking system is working. So I think we would need to, the final order, to really think very, very carefully about what sort of provision we're going to be needing. In May, they had a dispute with the finance director and he immediately left the company. And we have to think why. What was the dispute? Was it that the internal control system had faults? Was it that a fraud went on? What was the nature of this dispute? It's usually not good if the finance director leaves there. The company has temporarily asked the financial controller to take over the role while they recruit a permanent replacement. Now, the problem is here that we're having the financial statements now being prepared by someone who is probably less experienced and less skilled than the finance director who left. Furthermore, this guy is going to sue us for unfair dismissal. This is in the nature of a potential contingent liability here. The company is not proposing to make any provision, but whether or not a provision is or a disclosure is made depends on how probable it is that there will be an outflow of assets, whether it's possible, probable, or remote. And we have to look very closely at how the contingent liability should be dealt with. Now there we have identified quite a few risk factors. The part A said that it was for 10 marks. It said that we had to identify and explain the audit risks. Identifying isn't probably going to get you 1 mark. Explaining is the really important part of this here. And identify and explaining, I don't think you can say it's 1 mark for identifying and 1 mark for explaining. I think you want to certainly be getting more than 5 elements down here in your answer, more than 5 sorts of risk down here in the answer. I think just getting 5 down is not enough, and we've seen that the scenario is full of stuff there. There's a lot of stuff going on there. Most of it terribly obvious, and one should be able to say get maybe 7 or 8 points down, which is a much safer budget to be looking for. Part B, for 4 marks, asks you to discuss the importance of assessing risk at the planning stage of the audit. Now read it carefully. This is not asking you about the importance of planning. It's asking you about the importance of assessing risk at the planning stage of the audit. There are 4 marks, and it probably doesn't want much more than 4 good reasons for assessing risk at the planning stage. You won't have very much time to write there. 6-7 minutes, something of that sort. Anyway, here's my suggestions. First of all, we could potentially say that nowadays audit is a risk-based approach, takes a risk-based approach, and what starts out off is inherent risk, the risk that an error takes place initially, and then there is control risk, the risk that the client staff don't pick up on that error, and those two together will dictate how much work the auditors have to do to keep the audit risk down. So if you have no idea what the inherent risk is and what the control risk is, you have no idea how much work you need to do to be able to give your audit opinion with reasonable confidence. Secondly, it's important to understand the entity. You can't go into an entity without, for example, knowing roughly its size, nor can you go into it without knowing what makes it tick, really. And part of this will also be understanding maybe where there are risky areas. So we don't need to refer to this particular example. The part B is not dealing with the scenario really, but the idea that the company is now selling 60% of its output to one customer is pretty important to our understanding of how that company makes money and where it may be vulnerable. Then we can ensure that we give appropriate attention to different areas of the audit. So if we've identified a very cash-based business, then we give a lot of attention to cash. If it's a company with inventory which is small and high value, then we know there's a real danger in some of that going missing and so on. So you give more attention to the riskier areas. It's kind of simple stuff. Analytical procedures will allow us to identify unusual balances and amounts. And analytical procedures, and this is departing from the question a little bit, analytical procedures used at 3 stages. They are used initially. They're used as a source of substantive evidence. and then they use the final review. So when you get the financial statements, the draft financial statements, and you see that the gross profit has kind of doubled or something of that sort, then you know that you really need to investigate that because this is potentially a risky area. It can allow us to reduce risk. For example, if we have seen here that they are hoping to rely on perpetual inventory and we are a bit unhappy about this, then by planning, by identifying at the planning stage, we can perhaps encourage them in time to organize an inventory count. We can choose the correct team. If we see lots of risks in a particular client, then we will probably put in a team with more experience. And finally, it will perhaps enable to identify in advance going concern considerations. If it seems to be trading badly, if key members of staff have left, if a major customer seems to be in financial difficulties, then we know that at some stage in the audit we'll have to look very carefully at going concern considerations. So again, plenty of stuff there, but remember, to answer the question, the importance of assessing risk at the planning stage of the audit, not the importance of planning. Part C asks you to list and explain suitable controls that should operate over the continuous or perpetual inventory counting system to ensure the completeness and accuracy of the existing inventory records at Smoothbrush Paints Company. It is focused on Smoothbrush. In a moment we'll see again that they have certain procedures in place, and we're looking at completeness and accuracy. There's nothing in there to do with valuation. It's really the physical presence and quantities of stock that has been investigated. And in fact, we've raised quite a few relevant points already. So let's look at the part of the question where the inventory count is described. And again, we should use this as our friend. The detail in the question can be used as ammunition with which to answer the question. So let's just read through it and just raise some points, some weaknesses again that we could potentially mention. To avoid disruption of the year-end inventory count, they have introduced continuous inventory counting. The warehouse has been divided into 12 areas, and each of these is to be counted once over the year. And the first thing I think we could probably say is, if we're looking at controls, we need some sort of control to make sure that each is counted once, or maybe ideally in some cases more than once per year. So what is the control mechanism? Something could be just a simple sheet to tick off, if you like, and put the date on when it was counted. What is the control to make sure that we have done it once a year? The accounting team includes a member of the internal audit department and a warehouse staff member. Now, I said I thought this was quite good. It would certainly be bad if two members of the team were both warehouse staff members, because they have a potential vested interest in not reporting discrepancies. I might depart a little bit from the ACCA answer, which suggests that the accounting team should be completely independent of those who count inventory, maybe two internal audit people. The difficulty with that is that these people are not skilled in what inventory they are counting. And they can often miss items or misunderstand items. This is not too bad. There should be at least one independent person on the count team. And they have kind of met that that criteria, but we could say this is a control which should be there, that there should be at least some independence, or one person independent of the people who look after the inventory. The team prints the inventory quantities and descriptions, and these records are then compared to the inventory physically present. We've made one point here already, that we are well, let's go on here. Any discrepancy in relation to quantities in the inventory sheet, but if we put down the inventory quantities on the sheet, then we know the answer. We could skimp on counting, we'd be careless, we could pretend we counted, we could cover up discrepancies. It's really bad that they put the quantities on there. A second and more subtle point here is that we print out the inventory we think is there, and we make sure it is there. How do we identify inventory which is present but which is not on these sheets? Especially if you're doing a 12th of the inventory each month, for example. I mean, most inventory is not going to be on the sheets. So how do we know that over a period of a year, for example, there isn't some inventory sitting in the warehouse which has not been on any sheet at all? It might be quite good to have a kind of two-way count, or almost, or maybe a count from inventory to the sheet. So you count the inventory in that space, and then compare that to the sheet as well as the other way around. So we're looking for discrepancies. Now, it says down here that any discrepancies in relation to quantities are noticed in inventory sheets, including any items not listed on the inventory sheets but present in the warehouse. Now, I'm not quite sure how they actually kind of do that. You could do it for a specific element of inventory. Let's say we expect there to be 100 litres of red paint, but in fact there are 110 litres of red paint. So we can note the extra 10 litres because we've been told to go and count red paint. But what happens if there's a purple paint in the warehouse which never appears on any inventory sheet? Unless we go from inventory to sheets as well as from sheets to inventory, we're never going to pick that up. Any damaged or old items are noted and they are removed from inventory sheets. Now, we've mentioned this already. This is just kind of arbitrary removal of the inventory of damaged inventory. Well, we don't know it's worth nothing, and anyway, it might be quite interesting to keep track of how much is removed, how much is effectively written off there. It seems a bit easy just to strike it out, saying this is bad or this is old, without further investigation. The sheets are then passed to the finance department for adjustments to be made to the records when the count is finished. Now, do they just make these adjustments without any questioning? Who makes the adjustments? What is the seniority of the person who's making the adjustments? Are the adjustments authorized in any particular way? If they weren't authorized, we could have all sorts of discrepancies getting through, all sorts of amounts of inventory being written off incorrectly. We've already mentioned here there'll be inventory movements when the counts are going on. It's almost impossible to cope with that there. The last bit is nothing to do with this question, with this part of the question. This is to do with valuation of the inventory. It is nothing to do with what is required in this part, which is completeness and accuracy. The assertion of valuation is not being addressed in this question. Part D asks you to describe 3 substantive procedures the auditor could perform at year end in confirming valuation of inventory and the completeness of provisions or contingent liabilities. Substantive procedures, nothing to do with controls. Okay, there's test of controls, which tests controls, And there's substantive procedures which go more directly at testing the balance. Okay, so let's see what comes up here. Let's think about the valuation of inventory, and of course inventory is valued at the lower of cost net realizable value. So we need substantive procedures to address both of those. So here is our kind of suggestion. The way you get to cost is you can look at the invoices from suppliers, and I think 40% of, was it 60% of inventory is still is actually brought from outside now. So 60% is imported. So we can look at the invoices from recent deliveries. 40% is manufactured, so we have to look at how that is valued, and that is built up from material, labour, and indeed overheads. Let's just correct that. So we need to look at our costing records. We need to look at what materials go into, say, red paint. We need to look at how much labour it costs maybe to produce 1,000 litres, and how their overhead absorption rate is actually calculated. If you don't do that, you have no idea about the reasonableness of the cost of manufactured goods. On the other side, net realizable value. Net realizable value is what you sell stuff for, and the way to look at that is sales invoices primarily. You might also get some, it's not been put down on this sheet, but you can also get some information sometimes from looking maybe at board meetings or correspondence. If somebody says that a certain inventory seems to be kind of past its sell-by date and so on. And that leads us on to analytical review. Analytical review is part of substantive tests. Look at the aging of inventory. By and large, the older inventory gets, the chance of its net realizable value decreasing gets larger. And we can look at the levels of the provision made, and we know that in this case they are thinking of abandoning their 1% provision, which casts some doubt maybe on the inventory valuation. In terms of the completeness of provisions of contingent liabilities, always there's pretty standard stuff with the contingent liabilities. Board minutes are really important. In board minutes, you would expect to see the board discussing large contingent liabilities, things which might happen and which might be very serious if they happened. It's a kind of natural worry to everyone, and you'd expect to see something in board minutes. You would get correspondence from look at correspondence from lawyers, and you may indeed write to the lawyers for an up-to-date opinion. There may be correspondence with the ex-financial director or the ex-financial director's lawyers, just to see how serious this person is and what sort of amount of money they're actually looking for. And then there would also be a letter of representation from the directors saying that they think all liabilities are included and so on. And we should just mention here that the question said it was talking about the completeness of provisions of or contingent liabilities. So it's not just to do with the finance director. That this is the one that's come to our attention, but there may well be other contingent liabilities on maybe people claiming over bad inventory that was supplied to them and so on. And that's where the things like a board minute becomes really quite important and corresponds with lawyers. It's fairly open-ended. We mustn't restrict ourselves to what grabs our attention immediately.